I don't think it goes down 25% because there's ETFs and there's, the market is more mature. So let's say let's say 90,000. So it goes from 100 and where did it get to? 110 down to 90,000. Okay, that seems about right. So not far from where we are now. And then it finishes the year in a worst case scenario. I think it's like 200, 250. In a base case scenario, it's kind of 350. And in a blow off top cycle like 2017, back end of the year, could go north of 500,000. If they still have to continue to roll the debt and debase the currency and drive asset prices up, let's use this opportunity to make as much money as possible, that when we go into the early 2030s and the world is starting to move in ways we don't understand, where the study of economics doesn't even really work anymore, that we'll be secure.
Bitcoin remains on a long-term exponential growth path despite its notorious volatility. Liquidity cycles directly impact price fluctuations, but Pal argues that these drawdowns are temporary. He predicts that 2025 will see Bitcoin and other cryptocurrencies climb significantly, driven by increased adoption and liquidity injections. Pal outlines a probabilistic price range for Bitcoin. Worst case scenario, $90,000. Base case scenario, $250,000 blow-off top scenario, over $500,000. This range reflects the maturation of the market, bolstered by ETF and broader institutional participation.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
So really what is driving equity markets is the action of the Federal Reserve plus the Treasury. And that's the Treasury general account, that is the reverse repo, that is the balance sheet, and then in addition, it's what the global governments are doing. So global liquidity is the big driver of everything. So if we know that there is, 8 trillion or 10 trillion of debt to roll this year, the bond market's already struggling, they need liquidity. Well, the probabilistic outcome is we're going to get a lot of liquidity. Trump also likes high asset prices. So the chances of this being another strong year for equities is high. It will be probably volatile, probably more volatile than last year was. But I don't see a world in which it won't if the government rolls its debt, which it has to do. And it's the same for the Europeans, it's the same for the Chinese, it's the same for the Japanese. Everyone's got the same thing to do. And to do that, they inject liquidity. So Bitcoin is also driven by global liquidity, but it's also the adoption of this new technology, which puts it in this stupid exponential secular trend, but with volatility. The volatility, the big volatile drawdowns are just driven by liquidity. So this year, we've already established is a liquidity positive year. In fact, a very big liquidity positive year because you need to roll all of this debt. So generally speaking, it should be a very good year for cryptocurrencies. However, we're in this period where the Federal Reserve and the Treasury, and because of the dollar, have tightened liquidity over the last couple of months. It's forward-looking, so it's affecting cryptocurrencies right now. So they've been soggy for a while because liquidity was tightened a while ago. But again, our expectation is, it shouldn't last that long in price or time. And then we've got liquidity all the way through this cycle. Now, if we go back to 2021, the prior post-election cycle, because the pandemic had seen the global economy go down to zero, then go straight back up again, the business cycle peaked really early in April 2021. Normally in these presidential election cycle years, the business cycle peaks towards the end of the year. So Bitcoin had a very complicated 2021, but what we're doing now looks very similar to the 2017 post-election for Trump. And what we saw then was ongoing injections of liquidity. We started the year with a sharp 30% correction or 25% correction, the sort of thing we're getting now. And then liquidity just came all year. And it wasn't actually massively put in by the US. It was actually China last time. And I think we might see that again this time, where China is going to play an important role in global liquidity. So I think it's going to be a much stronger year than people expect. People have a lot of PTSD from 2021, where it peaked early, then collapsed, then went back up again, then collapsed. I think it's going to look more like we saw in 2013, 2017. So yes, I remain very bullish for this year on all risk assets. I don't think it goes down 25% because there's ETFs and the market is more mature. So let's say let's say 90,000. So it goes from 100 and where did it get to? 110 down to 90,000. Okay, that seems about right. So not far from where we are now. And then it finishes the year in a worst case scenario. I think it's like 200, 250. In a base case scenario, it's kind of 350. And in a blow-off top cycle like 2017, back end of the year, could go north of 500,000. It's difficult to know, so I always kind of give a probabilistic tree of, these are the kinds of zones. This year will be a good year. We will go to much higher valuations. And then, after we've rolled the debt, we tend to tighten liquidity because the inflation pressures have come back somewhat. That tends to draw down the markets. We kind of reset again before we start this cycle all over again. My working hypothesis is this is going to be, valuations will get expensive this cycle. The correction may not be large, maybe just be a year of sideways, down 15% something. But the next cycle, because that's when AI, robotics, self-driving cars, missions to the Mars, all of this starts hitting, we will go to a full bubble cycle. And then we can think about what the world looks like after that. So I kind of think we're in a golden bull market, at least until the end of the decade.
China faces a severe debt deflation crisis, compounded by an aging population and a struggling real estate sector. To stabilize its economy, China must weaken its currency and stimulate demand, a delicate balancing act. The US dollar's strength poses challenges for global trade and growth. Pal suggests that a weaker dollar, likely under Trump's policies, would benefit global economies. Despite these headwinds, Pal believes that forward-looking indicators, including improved financial conditions and liquidity-driven growth, signal a strong year for the global economy.
Look, gold is driven by the same thing, which is debasement of currency. It just doesn't have a tech adoption curve, so it doesn't go up as much. So gold will, considering, again, we're in the liquidity cycle where you have to debase currency to pay your debts, gold should continue to do well. I'm bullish gold, and I think that'll continue to do well for the rest of this market, particularly, when the dollar starts falling as well. That's good for gold. So overall, I think it's a very good market for gold, very good market for most risk assets. If they still have to continue to roll the debt and debase the currency and drive asset prices up, let's use this opportunity to make as much money as possible, that when we go into the early 2030s and the world is starting to move in ways we don't understand, where the study of economics doesn't even really work anymore, that we'll be secure. Because it's much easier to do it from a place of security. Because we don't even know how our businesses will work in that environment. So that level of unknowing is too much for most people to deal with stress. But we've been given the greatest macro risk-taking opportunity of all time, which has been particularly within technology and crypto, because these are tech adoption curves that are playing into the trend of us being replaced by the AI. So we're investing in our own demise. We can make an extraordinary amount of money out of it. Yes, there'll be cycles and they'll come with risks and all of that stuff, but it'll set us up in a place that we can deal with change. Debasement of currency that inflates asset prices, that's continuing. Inflation itself, I see less so. And all I see ahead is a tsunami of technology that is so deflationary we can't get our heads around it. So yes, we will get business cycle inflation. Where will inflation end up in this cycle? I think it ends up below 2% and then picks up again and maybe gets to 4% and then comes off again. So I'm not wildly concerned by inflation, but as we said, those prices won't fall. So we've still got that issue. But if I look further ahead, I think this is maybe the most deflationary period anybody's ever lived through because of robotics and AI. It's we're creating infinite people, or people in inverted commas, at zero cost. I mean, Amazon now employs more robots than people. So they're the largest employer in the United States, I think, outside of the Postal Service, or maybe the largest employer. But they have more robots now, and the robots work 24/7, 7 days a week, never complain, never take a tea break. The economic cycle, and I'll use the ISM survey, Institute of Supply Managers survey from the US as the best guide, has been subdued. So even though we've had equity markets and stuff very strong, the economy's been subdued. So normally a growing economy, you should see the ISM above 50. GDP's actually been reasonably good, but there's something going on in the kind of manufacturing sector that is still sluggish. So the cycle has still been relatively slow, which has created this bifurcation of like tech stocks, which are not based on, debt dynamics or real world expenditures. It's a very separate kind of cash flow that they're earning. The traditional economy has been sluggish. Globally, Europe's slow. They haven't picked up yet either. The UK is a bit of a mess. Canada's slow. And then we go to China, and China's got a full-on debt deflation playing out. So bond yields are collapsing. They can't stimulate because their currency's too weak and they don't want to lose control of their currency. Everybody's desperate for the US to weaken the dollar because the dollar's way too strong for everybody. So the strong dollar usually slows the global cycle. Now, Trump's coming in. The probability is he'll do the same as he did last time, which was the dollar's too strong because the US needs to export goods. And a strong dollar means less exports, which means a larger trade deficit. So we're kind of a little bit in this no man's land where everything is slow. All the forward-looking indicators of the economy are suggesting, because the liquidity that went in and financial conditions over the last 6 months, they tend to be forward-leading, suggest that the economy should pick up significantly this year. Now, China's the one problem child. We have to, as I said, see the dollar weaken, but also the Chinese need room to stimulate. So then they can try and stimulate their economy. Now, the reason they're seeing this debt deflation is the same that we've all had similar issues, is too much debt, aging population, doesn't generate enough GDP growth to service the debts. And what you get is this big problem. And they've got it in the real estate sector, much like we all had back in 2008 and 2012 in Europe. They've got it in the banking system, much like everyone had in 2008 and 2012 in Europe. They've got the same set of problems because their demographics just are falling off a cliff.
As we approach the early 2030s, Pal foresees a world where traditional economic models may no longer apply. The rapid advancement of AI and robotics will redefine productivity, employment, and even the concept of value creation. He warns of an era of uncertainty, but also highlights the unparalleled investment opportunities available today. Pal describes the current environment as the greatest macro risk-taking opportunity of all time, particularly in technology and crypto. By capitalizing on these trends, investors can build financial security to weather the transformative decades ahead.